Did
one of
Al come
our-
on?
Not yet, but it'll take a minute or two to get
All
us
right.
live.
All right.
Yeah, we can start.
Oh.
A
Oh,
minute or two to get us live.
all right.
Yeah, we can start. All right, we are live, so I think we're just gonna wait another minute or so for one of our co-chairs to come on.
Shawnee's, Bobby, me, and Doris, and Yvette. Hello, Yvette.
Hello, hello.
I'm sorry, Dr. Levy.
It's all good. It's all good. All good.
It's a doctor in the house.
Hey, Dr. Levy.
Dr.
Hello,
Levy.
how are you?
Lil Mark's in the 8th grade. He'll be in high school.
Oh my goodness. This is his last year of 8th grade.
Yes, ma'am.
Ninth grade. Wow. Where did
I'll
that
invite you
time
to the
go?
graduation. You know, principals can get in free.
Please do. Please do.
All right, Christina, good evening.
Hi there.
Hey,
Hey, hi.
We are live and we're ready to go.
Oh, great, because I've been having a hard time connecting. We're ready for, what's today? Is it the rules and regs?
This is the investment committee meeting, so we'll start off with that and then everybody can just stay on Zoom. We'll adjourn and then have the legislative rules and regulations meeting immediately after.
Okay, sounds great. Sue, I'd like to call the investment meeting for the retirement system for February 20th, 2025. May I get a roll call vote?
Christina Bennett,
Present.
Lewis Cross,
present.
Emily Hubbard, Shanice Johnson,
Present.
Yvette Levy,
Here.
Jennifer Orr, Bobby Richardson,
Present.
Albert Sanders, and Doris Walker.
Here.
All right.
Thank you. We've established quorum. I'd like to jump right into the meeting. It's going to be a long meeting today. So we have Jeff presenting, I believe, today.
Correct.
So I would go ahead and Jeff, the floor is yours. I appreciate it.
Fantastic. Good afternoon, everyone, and hope everyone's staying warm in this bit of a cold snap. And lucky the Cardinals are down in Jupiter, so they're I'm sure they're a lot warmer than the rest of us. So
Man,
we're all looking forward to baseball season soon here as we get a little bit warmer. So, Sue, we have the quarterly report and the January on the agenda. I think just in the interest of time, I'll stay pretty high level with the quarterly report, and then we can get into the more current January update and then leave us some time to jump over to rules and regs.
Okay, so you want to start with the quarterly report?
Yeah, yes, I'll hit some high levels on that. So if you want to go to find a page number for you on that. Let's go ahead and start on PDF page 4.
Is that the one you want?
1-4, there you go, right there. Good. So we'll just talk a little bit about what happened in the quarter. So we lost it. Oh, it's back. the top chart is the results of various asset classes for the quarter, and the top section of that chart, those are all the equity markets. So S&P 500, that's the one we all hear about all the time. It's on the news and in the newspaper, and those are all the large cap stocks and the big technology names and everything else that we all hear about. And that had a pretty good quarter at almost 2.5%. And if you look at the two that are at the bottom of that section, the Russell Midcap, Russell 2000, those are midcap and smaller cap stocks. So those are a lot of other companies that some maybe you all hear of, but there's probably a lot in there that we just don't. Those are the ones that are starting to get out of the gate and hopefully getting good earnings and growing and doing good things. And so hopefully someday we'll become big, large cap companies. There's been a bit of a discrepancy over, you saw it in the quarter that they lagged a little bit relative to those big cap stocks. And you also see that if you jump all the way down to the chart below, that you still have that discrepancy. Again, S&P 500, great 1 year numbers at 25%. So we're really a fantastic year for those stocks. The mid and small cap stocks, the Russell 2000, still a great year. 11.5% for small cap and 15 for mid cap. So nothing to sneeze at as far as results, but you can still see that discrepancy between those stocks and the large caps. And really a lot of that just having to do with when we have the kind of news and market volatility that we've seen over the past several quarters, that investors do tend to climb up to things that are perceived as being safer, and that's what they think about some of these large cap stocks. And again, don't want to overlook the fact that there's just a pretty sizable technology portion to that S&P 500, which again, if we're opening up the newspaper or turning on the news, we're always hearing about Nvidia and Tesla and artificial intelligence and all these things that everyone's really paying a lot of attention to these days. And so it's really those companies that have been involved in those types of stocks that have gathered a lot of interest from investors, and that's where the money is going, for better or for worse. And when I say for better, if they're good companies and they make a good product and they have good earnings and they can grow, then certainly there should be money continuing to go towards them. When I say for worse, it's sometimes people just invest in things because it's a fad and they don't really look at how well the company does, and do they have good earnings, and are those sustainable earnings, and can they continue to make money at a pretty rapid clip over time? And if not, then we say those are probably overvalued. So smart money managers, like the folks that we look to continue to recommend and employ for this program, we're paying them to make that decision to say, this is an overvalued stock and we're going to pull back on it or not have as much because we just don't like the prospects of it. Unfortunately for some managers, it's a tough environment sometimes to fight that tide. So the rest of the world, who maybe isn't as astute but keeps throwing money at these things, can kind of keep moving the needle upwards, while a money manager that knows a lot about these stocks and understands the pitfalls, who might pull back and be a little bit more risk conscious, pays a little bit of a short-term price in underperformance by not sort of jumping on the bandwagon and following along with these names. So kind of setting the stage a little bit as we go and look at some of the managers within the program. But By and large, just again, a great year. And from the type of asset allocation that this plan has with a good amount of equity exposure, certainly that translates into a nice solid year of performance. So the middle section of those lighter colored bars, those are the international equity markets, didn't have as good of a quarter. Again, a lot of that just having to do with investors moving away from things they don't perceive as being as safe in the markets. And so generally the international markets tend to be more volatile, have more ups and downs than the US markets. So this was one of those where investors took a look and said, well, between an election that's coming up and has now happened, and some of the things that might go on with the new administration, makes them a little bit more nervous with respect to some of those stocks. And fast forward to today, and we've seen what this new administration has put forth with tariffs and other programs that might not be as friendly to certain countries and economies and international markets. So we'll expect to see that kind of volatility over the next couple of quarters until we start to see some of those issues settle out. And fixed income, that's the bottom section of bars, and those are various areas of the fixed income market. The one that's sort of the gauge of all things fixed income is the top line, which says that the Bloomberg US Ag. So that's all of the investment grade treasuries and corporate securities and mortgage securities. So it's a pretty good bellwether for all of the things in that market. Why are all of those negative? Well, that comes down to what's been going on with interest rates. So we go back a couple of quarters and we started to get the inflation under control, and the Federal Reserve, who sets monetary policy, that they do things to try and help out inflation picture and how that's handled. So remember, we went through a whole period of raising those interest rates, and that essentially is in an effort to make things a little bit more expensive for those that borrow money, and so to try to get pricing under control. And so we saw that happen post COVID, and we now got down to a fairly reasonable level of inflation. And so the Fed now changed that course and said, we think we can start lowering interest rates. So we did start to see a path for lower interest rates, and that was really good on a temporary basis for the fixed income market. That's sort of an inverse relationship. When interest rates are going up on a short-term basis, that's a headwind for bonds. When they're going down, that's a short-term benefit for the market value of bonds. So we had a little bit of a stretch where those numbers were good, but then we saw, again, some of this just having to do with the new administration coming in and other factors of inflation starting to level out and actually not coming down as much as the Fed liked. And so the Fed said, well, we don't think we're going to be lowering interest rates as much as we thought. So if you went back a couple of quarters and they said, going into 2025, we think we might have 3, 4, 5 chances to lower interest rates. And now with a lot of the new information that we have in the markets, they've come back and said, well, maybe we have one lowering of interest rates in 2025. So those things did temporarily cause some pressure on the fixed income markets, and that's what we saw here. And we'll talk a little bit about January. January was a little bit better across the board for all of the asset classes, and then February so far has been a bit up and down, but we continue to see some of that pressure on bonds just based on the fact that the Fed has continued to signal we are probably not going to be aggressively lowering interest rates. We might stay at this higher level of interest rates for longer. So ultimately, what does that do? It just, again, makes borrowing expensive for companies that have to go out and borrow money and manage their operations, but also hits consumers. So if you have credit card debt, your credit card debt's going to continue to be a little bit more expensive relative to where it's been over the past couple of years. And if you have a mortgage, your mortgage rates are going to continue to be a little bit higher than they have been. And, certainly if you're a new family coming into the market and looking to get a mortgage, it's going to be more expensive to borrow money than it was a few years ago. So all of those things have impacts not only on real estate prices, but certainly elsewhere. So if you have to pay more on your credit card, then you might not be going out and spending as much on new things as we go forward. So all of that kind of trickles through into an impact on the economy. So that was the quarter. And again, jumping down to the year, you can see that middle section of bars. International markets, despite a lot of that volatility that we saw throughout the year, still ended up on a positive note, just not as well as the U.S. markets did. So that top line in the middle that says MSCI ACWX US, that's all of the international markets. That's the developed markets, and that's also the emerging markets. And then two pieces that make that up are right below it. So the one that says MSCI EFA, those are all of the developed international markets. And then below that, it's the emerging markets. So those two pieces together sort of make up that entire top line. So a reversal that we did see for the latest 1 year period is that the emerging markets, again, remember my discussion on volatility and perceived safety. Well, we saw a little bit of a reversal of that, at least with emerging markets. So again, the market generally thinks that emerging markets are going to be more volatile and have more risk than the developed markets, and then certainly than the US. And so we see a lot more of ups and downs there that over time investors expect to get paid for. So because we've had the past couple of years of not so great returns in emerging markets, that's led to a positive thing, and that's the valuations are good, so they're cheap. So and that's what the rest of the world is sort of looking at right now to say how cheap are things, and is this a good time to get back into emerging markets? And we started to see a little bit more of that money move there for the past 1 year. But again, fast forward to where we are today, expect a little bit more choppiness and volatility there, primarily, again, going back to what we're thinking about for tariffs. So if you think of some of the biggest markets right now that are being targeted for these tariffs are China and Mexico, two pretty big pieces of the emerging markets. So the way some of those markets go, generally the entire emerging markets may go. Again, that's kind of par for the course. Some of these larger markets like China, and again, you have to think about how some of these people that make up investment indexes and categorize things, that they still would call China an emerging market, despite the fact that it's one of the largest economies in the world. But a lot of that comes down to classifications and how they run their market and other things. But nonetheless, it is still categorized as an emerging market, and sometimes the up and down of China will impact an entire index of the emerging market. So something we keep an eye on. And again, we'll talk a little bit about some of the emerging market exposure that the system has right now and things that we're thinking about in that area of the market. So bottom section on the 1 year numbers, again, the fixed income results. So they are positive, but again, taking a look at what happened in the last quarter of the year, that did cut into better returns that we had in general from fixed income from the first couple of quarters of the year. So still ended up on a positive note, despite the quarter taking some of that back. So I'll pause there. That was a lot. Hopefully that sort of sets the stage for what happened, and I gave everybody a little bit of flavor of what's going on up until February at this point. Okay, if there's no questions, why don't we skip forward a handful of pages, Sue, and let's go to PDF page 13. There you go. So this is the system's asset allocation picture as of the end of the year. And lot of numbers below that signify what all of our various targets are for each of the underlying asset classes. And that's why I always like to refer to the chart right above it, because it takes all that nicer to look at. So each of the asset classes are going to be signified by an upside down triangle. And so those are the actual allocations for each of the system's asset classes at the end of the quarter. And you'll see a vertical line within each of those shaded areas. That's the target. That's kind of by policy where we want to be and where we always rebalance to when we're doing periodic rebalancing. And then the gray shaded areas, those are the tolerable ranges. So, and why do we have those? Well, we have to have leeway because, again, if you think about what the markets have done over the past year, really strong U.S. equity performance, international's not as good, fixed income lagging a bit relative to other asset classes. When that happens, we can see those actual allocations deviate from the policy. And we like to give it an allowable range because if we always have to go in and do rebalancing to make sure we're spot on, then there's transaction costs involved, and whether it's a trading or commission cost, or whether there's impact by having to go into the market and sell it, there is sort of a cost and a trade-off. So that's why we like to give the areas of the market a little area to run. And when they start to move a little further from those vertical lines, that's when we come back and start to think about rebalancing. Now, we've been fairly systematic with this plan that once a year we do look at how we'll rebalance. But if the markets are fairly active and we have a real big up period in equities or a big down period that might move those triangles a little further than we're comfortable with, then that's when we come back to the board and say, hey, we would actually recommend a rebalancing, outside of what we do on an annual basis. But as we've been fairly systematic with the rebalancing process, we've been able to keep that in check. So, and as you can see, again, not too, nothing falls outside of the gray shaded areas. We did have a couple of things that we recently rebalanced, the hedge fund money, which tends to be a little bit more sticky and takes a couple quarters sometimes to get that money back. We did get some of that back, and so that helps us out with the overall rebalancing. But again, just taking a look, a little bit overweight in the U.S. equity area, core fixed income a little bit underweight, and then also on that global multi-sector, and then hedge funds still a little bit over. But again, everything within policy and nothing for us that falls outside of a normal rebalancing range where we would say today we need to take significant action to move things back into policy. Any questions on asset allocation? Okay, 2 pages forward, Sue. And we'll just touch on fees. Again, we always like to reiterate the overall fees that we're paying the investment managers for the system. So we're in an off quarter here. I know once a year we will have a median in here for each of the categories in the respective universes that gives us an idea of how all of these managers stack up. And I know we took a look at that, I think, at the last quarter. So again, we'll do that once a year, but this table's always in here in case anybody wants to look up fees and understand those. So again, how that reads, the fee in percentage terms is that estimated annual fee that you see the first column to the left. And then the market value, that's the actual amount that the system has invested in each one of these managers. And then the right next to that is the estimated annual fee in dollars. So that's if you multiply that percentage on the left times the market value, gives you the actual dollar level in fees. And then that estimated annual fee actually comes from a fee schedule that's all the way on the right. And so how most of the managers that have tiered fee schedules work is they they tend to charge a little bit of a higher balance for the first few $1 million, and then the more you have invested with them, the lower the fee, and that fee starts to come down. So mutual funds are a little different. They all have one fee. So if you see any of the mutual funds in here, we'll just have one fee and not a fee schedule. So DFA, for instance, if you look at the DFA emerging markets and go all the way over, that 0.44 is a single expense ratio. So no matter how much you have invested in there, it's always going to be the same. Now, some of the managers that do have these tiered fee schedules also tend to be negotiable on fees, and to whatever extent we can negotiate and get lower fees, we have done that. And I know at the last quarter, when we did look at all of these relative to the medians, for the most part, by and large, all of your managers are going to be either at or below the median fee. We had a couple that are a little bit higher, I think, on the small cap side of the equation, but some of those we have renegotiated to the extent possible, and others we've just said we understand what they do, we understand why they might charge a little bit of a higher fee, and as long as they're outperforming their index over time, net of the higher fee, we're comfortable with that. So, but again, we'll always come back and note outliers on this. So, but again, all of your fees continue to be fair and reasonable, institutionally priced. Anywhere, again, where you have a tiered fee schedule, we'll look to make sure that those are in line with where they should be. And on the mutual funds, again, what's important to point out is that the way mutual funds run, they can have a bunch of different share classes based on who's investing in them. You start all the way down at the bottom with a retail investor. That's just you or me. If we go out to our broker and want to invest in one of these mutual funds, we'll get what they call a retail share class. Those are expensive because we're not. If I'm investing, I'm investing a little amount in there, and so we end up paying more. And some mutual funds might have what they call front end loads. Those are things that charge a higher percentage before you go into the fund, and some of them have what they call a back end load. If you come out of that, you pay another fee. And then if you keep going up the tier of investors, all the way at the top is an institutional share, and that's where the system is. You all have so much money that when you invest with them, you get the lowest fees, and you don't pay loads, and you don't pay all of these extra fees. You pay whatever the lowest expense ratio is that each one of those have. So again, we monitor that when we go in and recommend any mutual fund, and we make sure you are getting the institutional or retirement share classes. Any questions on fees? Okay, my mouse froze up here. I'm trying to fast forward. Second page of that, so we just want to fast forward one. It's just the remaining managers in the program. So there's the real estate managers, and then Westfield, which is a small cap manager. That's one that we talked about. Their fee runs a little bit higher, but for a small cap fund, they're still fairly reasonably priced. And then you can see Exponence, which is a manager of managers program in the international markets. And again, for 0.5% on an international program that's very well diversified in multi-manager, that's a very reasonable fee. Okay, next page, Sue. This is our MWDB brokerage commission goals as of the end of the year. And if we go back one quarter to the end of the third quarter, I think we were in fairly good shape across the board. I think we had a couple that were still lagging. I think Systematic might have been one of them. And so we did some follow-up. And now you can see as of the end of the year, all managers were in compliance with the minimums prescribed here. So Lomax did 67% relative to the 33.3. Systematic was just right above that at 34. TCW 40. Westfield at 35. For international, we have that limit set a bit lower. It's at 10%, and Causeway did a good job there at 26%. Earnest is also at a 10% on the fixed income side. they did a bang up job there at 50, almost 50% being allocated out, and then Exponent's at 22% relative to their target, which was 10. So everybody kind of packed it in and had a good quarter and caught up and did a good job complying. Okay, I'm going to skip forward a few pages here, Sue. Find you a page number. Let's look at PDF page 25.
Yeah, and Jeff, I just wanted to do a time check with that second meeting. We're 30 minutes in, so.
What time do we want to start that?
Well, kind of had set like this meeting to be like 30-ish minutes, so.
Okay. All right, then I will be really fast. So
Okay.
let's take a look really quick. I do want to talk about this page 25 here, because this is sort of a new addition, and we wanted to talk a little bit about this because what this chart does is shows where the system's asset allocation is relative to the universe that we're currently measuring against. And so recall that we're utilizing a universe because the system is still below $1 billion. That's the universe of plans that we look at. But what we wanted to point out here is because while you're under $1 billion, you're getting really close to $1 billion, which means we have a lot of latitude to have the system allocated much more like larger multi-billion-dollar pension funds. This sub-billion-dollar universe can go down to very, very small plans. So small plans that really don't have latitude to do things like private equity, private debt, real estate, some of the other areas that the system is allocated to. And the point on this is because I'm going to get to universe rankings when we talk about performance, is that over the past year, a lot of things like private equity, private debt will have a longer lead time, and you have some newer private debt and private equity investments that are just starting to put money to work. And so it's going to be a while before we start to see the return that comes out of those. In a really fantastic market environment that we saw last year, where we have 25% equity returns, any of the smaller plans that don't have these private investments but have more in traditional equities and U.S. equities in particular had a much better year just because it was such a good equity year, and we're trying to still play catch up on some of those privates. So again, this sort of shows how you're allocated, and again, kind of dovetailing with what I said, your U.S. equity exposure in general is going to be lower than the median within the universe, whereas your private areas of the market, hedge funds, private equity, real estate in particular, are going to be higher because, again, you have the liquidity, the size, and other factors within this plan that allow you to do that, to garner more diversification. And over time, that's it's going to be a better place to be. It's just when you have a temporary year of very good equity markets like this, it does create a difference. So, Sue, let's jump forward really quick and we'll talk about performance. PDF page 27. Okay. So as you can see, for the quarter, we were negative. And so again, if you think about when we looked at those market charts where the U.S. equities were leading quite a bit for the quarter relative to other asset classes. So when we're lower on those equities, that's going to translate into a return that's going to be a little bit lower than the universe. So again, in terms of what the magnitude of that was, it wasn't huge. So negative 1.35% relative to the universe, which is negative 1.1. So it wasn't off much, but it does put you below median. But it also kind of tells us how tight the dispersion is amongst the rest of the universe. So just a few basis points on a percentage really make a difference for how those universe ranks are. But if you go out to the fiscal year period, again, total fund at just shy of 9%. So a great fiscal year, not too far off what the policy index is. So pretty close there. But you can see, again, this is that factor that I wanted to set the stage for in that allocation page. when you have a lower level of U.S. equities in particular relative to the average plan, you can see there was a bit of a differential to that median. So again, if we go out longer term, 3, 5, and 10 years, that magnitude is lesser. We're pretty close to our benchmark over time as we get to those 5 and 10-year numbers. Again, getting closer to where we're targeting for this plan to be, sort of in that 7% range for the actuarial return assumptions to work out. And again, when we get to the January report, we'll see how that has changed. But again, the universe numbers, you can see not too far off where the actual median fund is. So let's just talk about the 5-year number. So the system's at 6.3%, the median plan at 7%. So not a massive differential, but you can see where that still ranks at 70. Again, that just tells us that the dispersion is pretty tight amongst managers, that there's not a lot of differential in returns, but it causes what makes it looks like a very significant differential in the overall universe return. So again, 3-year number, that's kind of the number that Gwelda and I pay attention to right now in this point in time, because that's, I think, starts to reflect a lot of the changes that we've come in and made and talked about with this group. And so again, we're right around median. We certainly want to be better than median. And I think as we go forward and some of the additional changes that we've made in the plan start to get us there. But and again, the overall nominal return at 2.6%, kind of factoring in a really bad year that we had over the past couple of years in the markets in general, but pretty close to the benchmark. So again, I think as we start to see some of these changes that we've made, in particular, managers that have been a little bit lower and underperforming, Lomax, where we've reallocated some capital. On the emerging market debt side, we're starting to move that and move some other pieces around. And on the growth side of the equation, where we've reallocated, those are all things that we expect as we start to go through the next couple of years are going to tighten up not only that number relative to the policy benchmark, but also relative to the universe. So I'm going to stop there, keep it high level, and we can talk a little bit more about some of the managers when we look at the January report. Maybe the only other thing I want to point to on this, Sue, is why don't we jump all the way back to, it's going to be PDF page 85. And that's our watch list chart. And I'm going to spend just 2 seconds on it because this is gonna be a point of discussion in rules and regs. There you go. So this is our quantitative watch list. And again, how this is set up, it's really set up to reflect what we have in the current investment policy. So it says it has a couple of different criteria. If a manager has not met the index or its median or below median for 4 consecutive quarters, those are 2 areas. And then also if it has not met a rolling 2-year return or a 2-year median for relative to the universe, then it gets a red mark. And so we have quite a few that sort of hit that. I would tell you, Gwelda and I, and we talked to the committee about this before, think that some of these might be a little bit too short term and we want to extend that out. So we'll talk about what our recommendations are in rules and regs. So the one manager that will impact on this page will be Fidelity. So the Fidelity, if we go to a longer term sort of rolling look at some of these factors, and Fidelity comes off. Invesco does not. That's one we're going to want to talk about. They remain on watch, and that's one where Gwelda and I are likely to come in with a search for a potential replacement for that allocation. And then Lazard, remember, we already made a recommendation at the last meeting to reallocate that. So that is in the process of potentially being reallocated. And then the PIMCO all asset, again, that one's going to change a bit because they're longer term 3 and 5-year rolling numbers which we think is a better market cycle to evaluate, they're going to look better on those factors. So, but again, that's a quick look at the watch list as it stands today with today's criteria. Okay, Sue, why don't we jump over to the January report again? I'll be brief with that. And Sue, maybe just if you want to do a quick 2 seconds on PDF page 3. This is a look at the asset allocation. Again, not a major change from where we were at 12/31. So equity bumped probably a little further to the right. And you'll see why that happened as we move forward in the performance page. We did have a good equity market, but again, didn't move the needle too much. So all of the asset classes continue to be in compliance and pretty close to where our target ranges are. Sue, if you want to flip forward one more page. So here's the good news. New year off to a good start. So almost a positive 2% return for the total fund. And that brings the last 12 months out to almost 11%. So again, not too far off from where our overall policy index is. Now the 3-year number bumps up to a little over 4%. And then the 5 and 10-year number, again, recall from where we were at the quarter, starting to move still closer yet to that 7% level. So again, having a good month and dropping off some bad quarters that were at the beginning of those 3, 5, and 10-year periods now starts to move those up. And then you see the inception number again moving ever closer to a 7% return as well. So all of that has worked out pretty well. Again, I think from the standpoint of watch list items, and we'll talk a little bit more about it, but the Invesco Emerging Market Manager, we did take some money from Lomax. We're kind of keeping an eye on them. You see they had a better month, so that's good. We want to continue to see them trend in the right direction and start to close the gap on that 1-year number. But those have been the two things that we've probably paid most attention to, and we'll look to address accordingly within the plan. So I'll pause there and see if there's questions. I know that was quick, but again, a good month. February so far has been off to a decent start for the equity markets. Fixed income has been a little bit more subdued, but so far we're still looking at a positive February halfway through the month. So. Questions, comments?
Any questions? Hearing none, I'd like to entertain a motion to adjourn the investment meeting.
I would like make a motion today to end the conclusion of the investment committee.
All
Second.
those in favor, please say aye.
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 Aye. Thank you, everyone. So Sue, it's back to your court. You're on mute. Oh, there you go. Who's the chair of the next meeting?
I was on mute.
That'd be-
Yeah, so we're the Legislative Rules and Regulations Committee. We have Dr. Levy and Doris Walker.
Well, we'd like to call the Rules and Regulations meeting to order. Stu, can you give us a roll call?
Christina
For
Bennett,
those present.
Present.
Louis Cross,
Present.
Emily Hubbard, Denise Johnson,
Sorry, couldn't unmute. Yes.
Yvette Levy, Yvette is here.
I'm sorry, I thought you heard me. I'm here.
Yeah. Jennifer Orr, Bobby Richardson,
Bobby? She frozen?
she looks frozen, doesn't she? All right, Albert Sanders,
That's what the weather do to you. It freezes you. But I'm present.
Doris Walker.
Present.
All right. We do have 7, so we do have enough for a quorum. So I also wanted to welcome, we have our colleagues from Hush Blackwell that have joined. We have Allie Winters. And then we have Christine Taylor as well.
Yes, good evening. Thank you very much, Sue and Chairman Cross. My apologies, I'm not there with you guys in person this evening. You can see by my great headwear that I'm working from home today. But I'm excited to say that I'm joined by one of our wonderful colleagues, Christine Taylor. So she has been instrumental in some of the interpretation of the Missouri statutes and also with the board's rules and procedures and things of that nature. It has a very strong background in statutory interpretation and work in higher ed. And things of that nature. And then we also have Maddie Green, I believe, is on the call as well, who, as you all know, works with HB Strategies and has been very wonderful with tracking the legislation and working closely with Sue and Chairman Cross on the negotiations and ongoing discussions with the pending legislation. So Christine, was there anything else that you wanted to say? I'm excited to have everyone on the call this evening.
Hi, everybody. Thank you for having me. I'm coming to you from Milwaukee, Wisconsin. But as I was telling Allie earlier, I do have some ties to St. Louis. We hosted 11 years ago a college baseball player who we now refer to as our summer son. And we still have contact with him, go to visit him in St. Louis. So we're in St. Louis at least 2 or 3 times a year. Love the city and really enjoy it. And I'm happy to be here with you all.
Well, thank you for
Welcome.
joining us.
Well, thank you for those introductions, and we can go ahead and get started.
So I think Jeff, we're going to put up the bullet points that you put together for your recommendations.
Okay, just to set the stage for everyone, this is kind of an excerpt of recommendations for the investment policy statement and operating guidelines. So again, it's a healthy and recommended process that these are always reviewed and any changes are made and we stay current on this. So a couple of things. Again, we talked a bit about our recommendation for changes to those watch list criteria. Again, those criteria come directly from the investment policy statement. So we always want those to tie out and be reflective. And then the rest of this is really going to be more of just truing up this statement to changes that we've made over the past year in the investment structure. So with new managers coming in, again, we have a section of the investment policy statement and guidelines that actually lists out all of the systems managers, all of their benchmarks, all of the universes. So we want to make sure it's fully reflective. And then also if we had any potential or recommended benchmark changes or universe changes for any managers, that all gets encapsulated. So that's what we have here. I sent Sue the entire operating guidelines investment policy with a red line, and she said, that's messy and it's ugly, and it is. And so we said, let's see if we can simplify this and put it in readable format here. So happy to read through all of this and go through it. And if there's any questions, just kind of stop me along the way. But and then Sue or Christine or Allie, I don't know if you all want to opine on how to make this a motion, if it can be all one motion or if you want to part it out. So I'll sort of defer to council on that. So why don't we go through it, and then once we get to that point, we can decide what we want to do with it. So so the first section here, which is A, is again, this has to do with the section in the guidelines that talk about our watch list. So that is section 7B. And so our recommendation here is that it reads, a manager will be placed on a probationary status if any of the two following conditions exist. And that's kind of similar to how do we have it now. If any of the two of the four that we looked at in that chart get hit, then it shows up as they should be on watch. So those mechanics will stay the same. We're just sort of changing what each of those boxes is now measuring. So box number 1 would be the manager has failed to meet the return of the benchmark index over a rolling 3-year period. The second box would be the manager has failed to meet the return of the benchmark index over a rolling 5-year period. The third box would be has not achieved a median ranking in the applicable universe over a rolling 3-year period. And then the fourth box would be the manager's return has not achieved a median ranking in their assigned universe over a rolling 5-year period. So again, really what we're doing there is trying to take away that short-term, what we call a head fake, because we know managers on a quarterly basis can have misses, but if we're sort of tracking those and constantly putting managers on watch, that watch list just tends to be a lot bigger than it really needs to be. So what we're looking to do here is recommending that we go out to longer tracking cycles for those managers' performance relative to a benchmark and also relative to respective peer universes. So that's the first section, and the rest of them are kind of easy. So the rest of them are just our housekeeping. So so B refers to the appendix, which is entitled glossary in the IPS or in the document, and that shows our different universes and benchmarks for each of the for each of the asset classes. So right now the private equity is labeled as, I believe, Cambridge private equity. We just wanted to change it to private equity benchmark, and the main reason on that is that we've seen a lot of craziness going on with different benchmark providers out there, and some providers come back and say, well, we're not going to do our benchmark anymore, or if we are, we're going to charge a lot of money for it. So we want to stay a little bit more flexible there to say, if at some point in time we have to change that benchmark from Cambridge to another provider, that we're not always constantly having to come back and readdress that in the policy. The second is the changing the private rating index to the S&P UBS leveraged loan. So again, that's the index that we are currently using for that, and that's going to be a little bit different from what was historically being used by the prior consultant. So the next is asset allocation policy. Again, it's Appendix 2. We eliminated, or we made a recommendation to eliminate the dedicated emerging market debt manager, and that's to be reallocated. So we wouldn't have that category anymore. So we would delete that as a line item from the policy. And then as part of that, and again, remember the recommendations that were made at the last meeting. So reallocating the emerging market debt to a new global multi-sector manager, and then also taking some of that Manulife money in the core space over to another core plus manager in Loop Capital. So ultimately, what does that do? Well, we will have to increase our global multi-sector target because we're adding a manager there to 12%, and then have a minimum of 9 and 15%. That core target doesn't change because we're just taking from one core manager and moving over to another. But we would have to change this multi-sector target and mins and maxes there as well. Again, a little bit more housekeeping on Appendix 3, which is the benchmarks, and a lot of this is just going to have to do with managers that have been terminated and or added, so reflecting what those changes have been. So recall that a while back we did terminate Intech as a large cap manager, and we allocated that over to Mellon US Large Cap Growth Index. So this would reflect that change. We also added, remember, we took some money away from Lomax and then put some in the index. So this was in the Mellon Large Cap Value Index. So again, that's adding that as a manager, with its benchmark being the Russell 1000 Value and its peer group being the IM Large Cap Value Managers. And then also there's also a segment on that table that outlines whether it's a separate account, whether it's a mutual fund or a commingled fund. And so this one is a commingled fund, and it would be denoted that way. Number 3 is add Loop Capital. Again, that was a recommendation from the last meeting. So Loop Capital is a core plus fixed income manager. Its benchmark would be the Bloomberg Aggregate. Its peer group, the IM Broad Market Core Fixed Income, and that is also a commingled fund. Change. This is one we talked about a couple of quarters ago. Recall after Loomis came in and made a presentation, and we looked at their benchmark, and they said we think we probably want to be benchmarked against an unhedged fixed income universe, and so here we would change the universe group assignment to the unhedged fixed income managers. I'm sorry, I'm talking about I'm on the wrong section. That was 5. Neuberger, they were the ones that came in and had the discussion. I'm sorry, I'm jumbled up here. So they are currently with an unhedged index. They recommended and asked us to change them to a hedged index. And so that's what number 5 would reflect. And then 4, that's Loomis. We're recommending changing them to a global unhedged fixed income manager universe. They're currently against what we call a global other universe, which is kind of a hodgepodge. Again, I think that's a carryover from how they were the universe they were using with the prior consultant. But we think this IM Global Unhedged is a more reflective universe for what Loomis does. And number 6, again, this is a new manager ad for what was recommended at the last investment committee meeting. This is Wellington Multi-Sector Credit, and their proposed benchmark would be the Bloomberg Global Multiverse, and then their assignment again would be this global unhedged fixed income managers. Number 7, that's Exponence Yield Advantage. That's a program that we terminated, so we would delete that as a line item from the table. And then same thing with Lazard Emerging Markets Total Return Debt. That was from the last committee meeting, part of this overall fixed income recommendation to terminate, and so that would be deleted as a line item as well. I will pause with any questions.
Jeff, did you say we can merge some of these together?
Merge. I'm not sure.
I think you mean for the motion.
Yes.
Oh, okay. I'm sorry. That I will. Like I said, I'll defer to council on how they want to do this motion wise.
Sue, did you have it drafted a certain way, or did you have a thought on how you guys wanted to do this?
I think this was at the very top. We have, like this could be, one giant motion, but we could, for doing the motion, we could actually just say as recommended by the investment consultant.
I see no issue with doing it at large unless there's specific factors that people would like to independently voice concerns on, or to vote on category by category. Christine, do you agree?
I would agree, yes.
So motion as read.
I'd like to make a motion to amend the investment and operating guidelines as recommended by the investment consultant and discussed in committee.
Second.
So it's been motioned and second. Is there any discussion? Hearing none, Sue, can we get a roll call vote?
Christina Bennett,
Yes.
Louis Cross,
Yes.
Shanice Johnson,
Yes.
Yvette Levy,
Yes.
Jennifer Orr,
She said yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Doris Walker.
Yes.
So we do have the motion carries. Now, Ally, if you could just explain, we had talked about, then this is a recommendation from this committee. We have the meeting coming up on Monday about then getting, this passed by the full board. What your thoughts are that could be done at just the one meeting?
Yes, and I will let Christine chime in, as she was actually the one who ensured that this was in compliance with the rules and regulations. But yes, we believe this could be done with a 2/3 vote at one meeting.
That, based on my reading of not only the rules and regulations, and investment policies, the way that I read it is that it's intentionally, for lack of a better word, vague in sections 1 and 2. And it's my interpretation that it takes the 2/3 vote of the trustees, and that's intentional given the volatility of markets and the need to make decisions quickly without having to take it to wait a month, take it to another vote. And that's the way that I interpret this. And that gives you all the flexibility to be able to make these decisions independently.
Okay, great. And then I think we also had Maddie here, just to weigh in if there was anything, with the legislature. There's, always things happening in session. If there's anything else impacting our, particularly on the investment side, anything we need to be, we have our guidelines from you, kind of letting us know where things are. But if there's anything we should know and take action on here, fairly soon, let us know.
Yeah, thanks, Sue. Ally and Sue asked me to pull together a list of pending litigation or legislation that may impact this board. And I did that. I'm not seeing anything that would require your attention right away. Certainly, if this board wants to comment publicly on any of this legislation, then that would be something to talk about. But I'll just give a summary, kind of a high-level summary of a few kinds of bills that we're seeing running through the legislature right now. And you can let me know if you want to talk more about them. Does that work, Sue?
Sounds good.
So there are a couple of several bills that prohibit Missouri state departments and educational institutions from spending state dollars on initiatives relating to DEI. They do not apply to the system, but that is a theme that we're seeing running through the legislature. So that's just something to be aware of. There are a number of bills that limit ESG and economic boycotts. It prohibits public entities from entering into contracts with companies that engage in economic boycotts, and requires political subdivisions to not give preferential treatment to those entities that engage in certain types of ESG. Those bills aren't moving very quickly. One of note, there's a couple of pieces that require public employee retirement systems to consider only financial factors when making an investment and not ESG. So that one is the only one that's moving. It was just passed by the pensions committee, but it still would have a long way to go. So the other sort of category of bills is limits on investment in foreign entities. I think that's something that this group discussed last year before I was involved, but generally it prohibits a retirement system from investing in Chinese entities. And then there's another bill that prevents a retirement fund from investing with any foreign adversary. And there's a list of countries in which they prohibit investment. And so those two have been heard in committee, but they haven't been voted out yet or moved much further. So those are just a few different categories of bills that we're seeing that might impact your work. But, in my judgment, none that require action at this time.
Yeah, and I think we did respond, to the legislature's request for any kind of impact on that last set of bills.
Yes. Yeah. We submitted a fiscal, a response to a fiscal request on that. So the legislature has that information included in the fiscal note when they are reviewing this legislation.
Okay. Well, thank you for that, Maddie. Appreciate it.
Yeah, absolutely. If there's anything you want me to follow up on, just let me know or talk more about. I'm happy to do that.
Okay. A question, do we have any current investments in any of those areas that are subject to possible violations from the legislature if they pass these bills?
Yes.
And which ones would that be?
Well, maybe Jeff, isn't it Asia Alternatives? Is the one that we did for the last.
Asia Alternatives, but there's also, both of your managers, again, this would have to, in your international space, so Causeway, potentially could have China exposure at any particular point in time. And again, we'd have to figure out, this is always the tough one with this administration is, who is now a foreign adversary. I think there's a lot more than there used to be. And so how that all gets outlined and who ends up on that list is, certainly could be impactful. But then again, it also, I think there's going to have to be a determination and where we've seen other states and governments try to deal with this before is that it's really hard to make that applicable to a mutual fund. So because again, I think you're going to have a lot of mutual funds in some form or fashion that could have exposure. So are they saying, well, if a mutual fund has exposure, do you have to completely get out of that mutual fund too? So just how that gets interpreted, we don't know, but there is potential for that. I know Sue, I think I did a write-up for you all not a while back on that, not only talking about what our thoughts were on it and how it gets implemented, but again, what the potential impacts would be to the total system if they were to pass something like that. So, and again, I don't want to go down this rabbit hole yet, but depending on how DEI shakes out and those types of things, does that impact, can we continue to have an MWBE brokerage policy? Can we continue to use, groups like Exponents who have that focus on emerging in MWBE managers? I think I think Christina had probably brought this up before, is we can, but it probably has to be framed and written differently as to how we do it. So
Yeah, Jeff, I thought we were going to talk about that today with some recommendations. For example, our brokerage program should be just our brokerage program, right? Instead of it calling our minority brokerage program, we just, we have mandates, we call them goals. We just have to come up with certain things that, you know, I doubt that Causeway looks at our investment policies on a regular basis. We've had them forever, and I doubt that they do. So if we change it from requirement to a, same thing the city of St. Louis does is we used to have MBEW participation, and we never had it mandated, but we had these strong goals to attain. If we do it that way, then we can still have our program and just call it our brokerage participation program. Um, we still want to talk about emerging managers. Emerging managers doesn't necessarily mean managers of color, right? You could have a spinoff of Meet and Vance, and they could totally be an emerging manager without discussing who their ownership is, right? So emerging manager is not necessarily a bad word. It's just like DEI is not a bad word. It's just people who choose to use it in the different contexts that make it a bad word. And so when do we look at our programs and make those recommendations? I thought they were going to be today.
Right.
Because the Tangerine Tyrant is not going to impact his portfolio or any of his peers' portfolios. So I doubt that they'll do and get out of all Asia products. But right, they're only going to do so much to satisfy a certain base. And we live in a red state, so we have to turn around and figure out how we reword some of our language to be, because we don't want somebody looking at our stuff in detail and then really be able to. Okay, I'm on the phone. To be able to do what we need to do, right? So I'd rather us be proactive
Yes.
and then be able to see what we can do. We don't have many strong mandates, except that we like to see emerging managers. But let's see where we go from here.
Question. So could we then charge Ally and Maddie and Christine to take a look at anything that needs to be changed in terms of wording and so forth, and then reconvene along with Jeff to make sure that we're in compliance ahead of time? Is that what you're suggesting, Christina?
Yes.
Okay. So
Because we're not in ESG, we don't have a policy allocation to ESG, so we don't have to worry about that.
okay.
So really, they're only going to come after anything that they see perceived as DEI in our guidelines.
Exactly. So then, Ally, is that something that we could do in a short period of time, or will it take quite a bit of time?
So and Chairman, just to make sure I understand, is the ask that we would compare the current policies as they're drafted and figure out how we would better wordsmith it to align with the currently proposed legislation and pending bills? Is that correct? So that way we're proactive in case they do pass?
Yes, exactly.
Okay. Maddie, what are your thoughts on that as well? Because I'm not sure if are there defined terms within those bills or any type of certain kind of key language that we should or shouldn't be looking out for if we try to wordsmith the policies?
Yeah, thanks, Ally. I'm happy to take a look at the investment guidelines and any other documents you'd like me to review and compare it to the legislation, the pending legislation. I will say that we know that lots of 2,000 or something bills are filed every session, and only a small number of them make it through. I would hate to waste everyone's time in discussing how we would make those changes and then the bills not pass. I totally understand being proactive, and I'm happy to do that if that's what the committee would like to do. My recommendation would be to wait until we get closer to session and figure out which of these bills, if any, are going to get through the process, and then talk about it. The bills will not go into effect until, I believe, August 28th, assuming they don't have an emergency clause on them, and I don't see why these would. So I would think we have plenty of time to kind of compare with the pending legislation, but certainly I'm happy to do that now too.
Okay, Maddie, then that sounds good.
Go
ahead, Jeff.
Yeah, maybe if I can help, maybe help target this too, and kind of make it a little bit more simple. So, Sue, outside of the investment policy and operating guidelines that we just reviewed and redlined, is there any other documents that are out there that would refer to emerging manager program or anything else? And if there's not, then really I think the only thing in this current policy where there's a reference is the MWDB brokerage program. Other than that, there is no reference or guidelines for for DEI or for emerging managers. That's just been more of an operating preference and practice for the board, in the committee. So
I agree. So that's what I was referring to. There's only one document, which is a minority brokerage program
Okay.
that I see. We don't have any mandates that we have to have the global equity with exponents. It was just a global equity search, right? So
correct.
they just happened to win it
Correct.
or inherited, one of the two. They inherited it.
So I guess, then Maddie and Allie, if, it's just the one document, we can have you look at it and just see, what your thoughts are about that document.
Sure. Yep. Happy to do that.
Okay.
And I think outside of that, I mean, I think it would not be a great process to go down the road of just starting to tell managers what you can do with China, or you got to pull China out, or these other things. I mean, I just think until any of that's defined and actually law, I don't think we should be telling managers what to do.
Yeah. I was just concerned because I remember we received some correspondence from the state early on about DEI, didn't we, Sue? They sent us something.
Proxy voting.
Yeah, proxy voting. That's what it was.
that was a couple of years ago.
Right. So they had been kind of circling the wagons on some things, and so but what you suggested, Maddie, sounds good to me, and so that's what we'll do. We'll just kind of wait and see.
Okay. And I'll still take a preliminary look at that,
Exactly.
at that document.
Exactly.
So that's all I have, unless you, or anyone else has any questions.
Take that discussion.
So,
No. I think that's what we had for this meeting.
Stop it. If you take that diaper off, I'm gonna whoop your behind.
This meeting's been recorded.
Oh, dang. Sorry.
Oh, good. No child left behind,
Yeah, well, someone will get someone has a poopy diaper and wants to take their diaper off. No, thank you. So I have to run, guys. Thank you.
Okay, Chris, take it easy.
Are you done?
You want to vote before you go?
Are we done with this? Are we done with discussion and everything?
That was what we had for tonight.
So can we make who can make a meeting to adjourn? How about the Bobby or Yvette? Don't y'all want to make a motion to adjourn?
Yes.
Or we want to keep looking at each other?
I would like to make a motion to end the rule and regulation meeting.
I second that emotion.
It's been moved in second to end the meeting. All those in favor, please indicate by aye.
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 Those opposed? The ayes have it. Thank you, everyone.
Thank you. Good night, everybody.
Thanks, everybody. Have a good
Thank
weekend.
you.
Aye.
All right,
Night.
bye-bye.
Good night.